Thanks. So I'm going to be having I'm going to have a chat to you about what's going on in the construction loans. What was the case, what is the case, and what we expect them to be. But I just want to first talk about that these things are ever-changing. So they don't stand still, and what we say today might not be the case, well, it won't be the case in a few months' time. But as is always the case, change also presents with it opportunity. And luck always favours the prepared. So if we think back to the first speaker, and you think, well, that was all the doomsday stuff. Yeah, it is. But it's the doomsday stuff for people that do not prepare, that don't take the necessary changes to get their business models ready to take opportunity as and when it presents itself. And over the course of time, there's been time and time again when, well, for example, like in our business, when the bank started to turn off the tap, when they started to tighten, you know? Like a lot of even my own team was saying to me, well, what do we do now that the construction loans are gone? But it's kind of been the best thing that it's actually happened to us because it's just re-articulated our value proposition in the marketplace. So we've had to adapt and we've had to change to find new and more exciting ways of being able to fund different types of developments as well as the same type of developments too. So I just want you to reflect on that for a moment, and I'm just going to play a short video clip that I think is going to demonstrate exactly what I mean. So I think that we're all pretty familiar with that clip, but it actually speaks to a lot of the very successful business owners here, you know, and a lot of the times you've made your success by being ready, by being nimble, and by being able to adapt and change. So in the land of development funding, what is it that's actually changed? And I'm going to be going through the 6 things that we've seen. One is the rate of change. Second is the level of scrutiny. Third is what the new lending appetites of the major banks are. Fourth is the emergence of institutional and other private lending options. Fifth, and in my opinion, the single most important one, is how all of these things are affecting your return on equity. And the sixth is the takeout and how do you manage your settlement risks. So the first one is the rate of change. Lending policies, the nice thing about it is that when I was up here about a couple of years ago, this is when it was starting to tighten. Banks didn't even know where they were going to end up in, or how far that they were going to go, or if they were still going to actually be lending. Now, the good news is that they all still are. All of the major banks are still giving out construction finance and they're getting them done. It's just that they're not getting them done in the way that they were. They're taking a lot longer, they're a bit more expensive, and they're lending a lot less. And I'll be going through those two. Second is the level of scrutiny that particularly the banks are applying to development lending apps. I've never seen anything like it. Yeah, like the amount of information that we've been asked to provide and the amount of things that you're being asked to start to prepare is just the new way for builders and developers to start to prepare your returns, the way that you need to get your accountants on board, and the type of financial information that you need to start to prepare is just the new normal. So what is it that you can be expected to prepare? Things like detailed work in progress ledgers. Some might, give them now, they'll give a few lines and say, well, we expect to start this in Jan and that in Feb and that in... It needs to go into a lot more detail than that. Next is the cash flow. So your cash flow, the cash flow forecast for the next year or 18 months moving forward needs to be in line with the work in progress ledger, needs to be in line with letters of intent that are out, needs to be in line with things that the banks can see and verify and know, and they need to be to industry standards. So they need to be right and they need to be accurate. So as a percentage of what construction cost, what are the subbies? As a percentage of what construction cost, what are all of the different items? And they're running them through and they're comparing them to all of your peers. So just to do a half-ass effort at, now is just not going to fly. And if you do that, it just takes longer and more effort to get your loan done. Even for existing clients, the amount of things that the bank is asking for people that they already know. The building checks are going back in some instances 15 years for developers that they've been funding for the last 10. Things that we haven't seen in the past. So again, these aren't things that you can't do, but it's just a matter of, okay, well, if you're going to do them, then start doing them as a matter of business. This is the new way that you need to run your business. For most mum and dads or for family development, these type of things were never really important. These type of things are what we used to ask and expect of our institutional clients. Now it's of every development client. Okay, so what's new in the marketplace? We're seeing a proliferation of new non-bank lenders emerging. There are so many of them. We're literally being hit with about 2 a week at the moment that are knocking on the door and asking for some business. When you're going away from bank funding, you need to be really careful. And it's not just about the rates, and it's not just about the fees, and I will get to that in a bit. The scariest thing for me with a non-bank funder is the certainty of the funds. Because a lot of them, particularly with the contributory funds, is they commit to giving you a loan, they haven't got the money yet. So they will enter into back-to-back agreements with 30 or 50 funder or investors in the back and say, this is the progress payment schedule and we'll ask you to put your money in on these particular dates. Heaven forbid, what if they can't or what if they don't? And you're in the middle of a job and you're waiting to get a claim paid. So you need to choose these people very, very, very carefully and be very careful of the new players which are about. And understand if it's a contributory fund and who the funder is and where they get their money from is really important. And we spent a lot of time before we put these lenders on our panel to understand their business models. The market for this type of thing is really broken up into the sub $5 million loans, 5 with $50 million, and then the over 50. And most of the new funds are in the sub $5 million space. There you've got all sorts and all manner of funders that are generally doing high OVRs with low pre-sales. They'll fund your side acquisitions, they'll do all sorts of things. Sure, it's at a cost, but they will do it. Loans under 5 mil. So as I was going through, generally you're looking at about 80 to 85% of the TDC. They will go to 65% of the GRV, often with little or no pre-sales. And they're not all that much more expensive than a bank. Well, some of them are. Loans 5 with the 50 million. This is the most expensive place to play. These are oftentimes very high net worth investors which are investing the one deal, or you're going to get a contributory fund. So in this space, the investors that sit behind these deals are looking for returns of about a 15% yield. Yield is different than an interest rate. So by the time you convert it to a rate, you're looking, and then fees and charges and all that type stuff, you're starting to look at around about 12 to 14% as a rate, plus a small line fee, plus some establishment costs, plus some legal costs. But the thing is that they're doing 85% loans, they're very flexible with the terms, and they're quick to market. No? They're very quick. They're not all of them, like they will produce a term sheet and then what you see in the loan offer documents are completely different. And we've actually raised a couple of well, not court cases, but with the ombudsman on behalf of some of our clients for commitment fees that they've gone and paid because we wouldn't deal with a particular lender or whatever it is, and then they come back to us. And so, like we're trying to take these people on as and when they come up, although there's just too many of them at the moment. So choose your lender really, really wisely. The really exciting thing now is that in the over $50 million market, you've got the institutional players that are starting to play in the stretched senior space. Now, these funds are very, very young, and they like to go from 50 to about 200 mil. There are some that will go over. These are, so just to explain why the cost of these funds is a bit lower, because they get the major banks, in most cases with the ANZ, to go and underwrite a big part of the loan, and then they fund the rest at a higher rate, and then they deliver the loan to you at a blended rate. So you're paying, I guess it's a bit like MES. Well, it's a bit less than MES because they're taking a first mortgage rather than a second, but you're getting a blended rate. Now, they're quick to market. They're very professional in what they do, but they're looking for an institutional style deal. The other thing I wanted to talk to you about was the settlement risk. Late last year, there was a lot of hype in the media and in all the press that with the doomsday had arrived and all these sales were going to start to fall over and your sales were not going to complete. Luckily, we haven't seen any evidence of that. There is a little bit up in Brisbane, but it hasn't been enough to destabilise the market by any stretch. And at the same time, the banks, they pulled out of the foreign buyer loans. That caused a really big disruption in the marketplace. We've been fortunate enough to have an affiliation with a company called Home Loan Corp, which I've got an interest in, so I'll disclose that. But they are funding non-resident loans now. So that money is starting to flow. There's a few different options there, and they are great at reporting settlement risk too. So you're going to get flagged very, very early on about any risks or any units that are unlikely to settle. So you've got time to go and maybe to reach back out or to resell the unit or see what you're going to do, but before the date of the expected settlement comes, and then you find out about it at that point. But that's one thing that you need to really continue to manage, particularly if you're relying on the proceeds of one development to roll into another development. Now, how does all of this and all of the change and all of the more money that you need to pump in or the high cost that you need to pay, how does that affect your return on equity? And by that I mean, for the past few years, you've effectively put little or no money into a deal. A big reason for that was you're getting an uplift in the land value. The pre-sales were easy to come by, particularly thanks to our mates at CBRE over there. And banks were lending on very high leverage, and they were accepting that uplift in the market value in a lot of times to be your equity contribution in. So if you look at the cold hard cash that you put into a deal and what you got out of it at the end, that is your return on equity. Now, unless you're still sitting on options from 2012, 13, 14, the next round that you're going to get need to start to play with cash. Now, do you put more cash into the deal and get the same amount out, or do you put less cash into the deal, willing to pay a little bit more with interest, and then get a bit more out of the deal? So it's sometimes, well, there is always going to be now with a trade-off, and you need to have a look at your models and your business models. So because a lot of the time, if you're not willing to pay more for the extra leverage, then you might need to start to scale back the size of the developments that you're doing, because that's what your cash is going to entitle you to do with the lower bank leverage. So with all these things that were in your favour, they're now starting to turn against you. And again, I don't want to be alarmist, because for some, this is a time of great opportunity. It just depends on what side of the fence that you want to be sitting on. So My advice, so how do you prepare? And it really depends on your circumstances. For a lot of very established clients now, we're doing complete restructures with their balance sheets, and that's to extract equity of the profits that they've made over the last 5 or 7 years and make them into available funds. Places like with the Macquarie Bank have fantastic facilities for your residual stock. They don't attract the line fee, they're very cheap, and it's a great product. You know, so I'd encourage you to look into doing a complete restructuring of your balance sheet, so at least you can start to have with the option. So if you've got all of that additional equity available to you in cash, then you've got an option. Do I go to a bank or do I not? Gear your long-term hold assets for as long as you can. So borrow long and use them short. Avoid getting these type of loans with line fees, because in the times that you don't actually use them, then they will incur a cost. The biggest one, and one that is the vein of my professional existence, is the way that if you have been dealing with a bank for a long time, they cross-collateralise you. And that doesn't just include taking mortgages over what you own, it also includes taking charges over your income-producing assets. And that, when a bank's got a charge over the company that owns that asset, that means it owns the income that it produces. So in a lot of time, you can't use that income to show that you can afford to repay another bank's debt. So it restricts your access with the capital. And that's the same as the last point too. So the charge is the old, with the fixed and floating charge. Now they've changed the term, but it's the same thing. And start using second-tier lenders, second-tier banks, the non-majors, for assets that you want to hold long-term, and use the major banks to do your development. Don't hold your long-term assets or your long-term loans with the same banks that you're going to be doing with the development loans with. It's a massive no-no. And that brings us to the end, so I hope that you've enjoyed the presentation. And if we can be of any assistance, we've got a few of my guys around the room, and I'll be around too to take, to have a discussion. Thank you.